Asian markets soar while rate cut hopes divide experts. Historic highs, global optimism, and a few warning lights in the rearview mirror. Thursday night's trading sent Asian stocks to record-breaking levels, fueled by mounting anticipation that the U.S. Federal Reserve is about to unleash a spree of interest rate cuts. If you're wondering what's really driving this latest surge and where the cracks might be appearing, read on. At the core, Asian equities took their cue from Wall Street's overnight climb, with hopes for lower U.S. interest rates rippling across the globe. This isn't just a feel-good story for investors. Lower rates typically mean cheaper borrowing costs worldwide, giving a much-needed breather to bondholders and keeping the U.S. dollar in check. The ripple effect spread to Europe as well, as Euro Stoxx 50, FTSE, and DAX futures each nudged higher by 0.2%. Meanwhile, SP 500 and Nasdaq futures paused at the new all-time highs set hours earlier. But here's where it gets controversial. Is this optimism justified, or are markets getting ahead of themselves? Asian indexes in Japan, South Korea, and Taiwan either notched new records or hovered near previous peaks. Meanwhile, China's stock market touched its highest point in 3.5 years, powered by perhaps overly ambitious projections for artificial intelligence-related company earnings. Could such enthusiasm lead to disappointment if tech profits don't materialize? The turning point was the latest U.S. consumer price report. This crucial data was seen as the final obstacle before the Fed could start trimming rates, and while it wasn't soft, it didn't ring alarm bells either. Specific components of the Consumer Price Index, CPI, those that the Fed uses to calculate its preferred core inflation measure, the Personal Consumption Expenditures, PCE, index, were surprisingly subdued. According to Citi analysts, the August PCE might hold steady at 2.9%. This is considered a positive sign for central bankers weighing a series of rate cuts. Veronica Clark, Citi's economist, offered optimism. This reading supports the Fed moving forward with several rate reductions. She anticipates 125 basis points worth of cuts across the next 5 policy meetings, warning that rates could even dip below the 3% mark if trends persist. But not everyone agrees. The market may be betting on 3 cuts before the year ends. But some observers remain skeptical about the Fed moving so aggressively. Currently, investors are betting with near certainty on a quarter-point reduction, bringing the U.S. rate down to 4.00% to 4.25% next week, with about a 90% probability attached to 2 more cuts by year-end. Bond yields, effectively a barometer for broader borrowing costs, have already fallen by 20 basis points over the past fortnight, providing, in practical terms, an early slice of relief. Lower Treasury yields generally translate to easier mortgage rates, benefiting American borrowers directly. This softening has also helped calm jitters in other major bond markets, especially in Europe, where fiscal worries and political uncertainty have been brewing. Look at the numbers. Tokyo's Nikkei leapt 1% to yet another record, posting a weekly gain of over 4%. South Korea's KOSPI surged 1.3% in one session, putting it almost 6% above the week's opening level. Chinese blue chips held at their 2-year highs, and the broad MSCI Asia-Pacific Index outside Japan jumped 1.2%. And this is the part most people miss. The European Central Bank, ECB, decided to keep its main rates unchanged, insisting the current monetary stance is in a good place. This hints that unless there's a major economic shock, further ECB rate cuts could be delayed. According to economist Greg Frazesi at J.P. Morgan, the ECB might postpone any final cut until December at the earliest, if it moves at all. Yet there's a simmering debate. Some believe growth prospects and subdued inflation will force the ECB's hand, while others see the central bank standing pat for the foreseeable future. After their latest policy meeting, ECB insiders revealed that December is the likeliest point for any serious discussion on further easing. At the moment, markets only see a 1 in 5 chance of another cut in December, and around a 60% consensus that the ECB has ended its cycle of rate reductions. Switching gears to currency moves, the US dollar drifted back to 147.40 yen after briefly touching 148.20 in the prior session. A joint statement from Japanese and US finance ministers reaffirmed that neither country would tamper with currency values, although, as always, the market remains alert to possible interventions if volatility spikes. Strikingly, gold prices edged up 0.5% to $3,654 an ounce, holding near the all-time record reached earlier in the week. Meanwhile, oil slipped as the International Energy Agency predicted that OPEC's increased output will lead to an even larger oil surplus next year. Brent crude lost 0.6% to settle at $65.91, while U.S. crude dipped 0.8% to $61.88 a barrel. Is this pullback in oil a blip, or does it signal deeper problems for energy markets? What's your take? Are markets sensibly pricing in this wave of global optimism? Or are we in the middle of a speculative bubble waiting to burst? Could the Fed and ECB be underestimating the risk of reigniting inflation with aggressive cuts? Or is this the perfect recipe for renewed economic growth? Share your thoughts and join the debate. Where do you stand?